Bismillah al-Rahman al-Rahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Understanding Business 2024, Chapter 19. Narrated by Omar Mohsen Ibrahim Fouad. Chapter 19. Using Securities Markets for Financing and Investing Opportunities. Page 500. Learning objectives. After you have read and studied this chapter, you should be able to describe the roles and securities, markets, and of investment bankers. Describe the roles of securities, markets, and of investment bankers. Identify the stock exchanges where securities are traded. Compare the advantages and disadvantages of equity financing by issuing stock, and detail the differences between common and preferred stock. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds, and identify the classes and features of bonds. Explain how to invest in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. Analyze the opportunities stocks offer as investments. Analyze the opportunities bonds offer as investments. Explain the investment opportunities in mutual funds and exchange-traded funds. ETFs. Describe how indicators like the Dow Jones Industrial Average affect the market. Page 501. Getting to know Ray Dalio, founder of Bridgewater Associates. Ray Dalio certainly had high hopes for Bridgewater Associates when he founded the investment firm in the 1970s. After spending years working on Wall Street, although his business had a difficult start, Dalio eventually found his financial stride, building Bridgewater into the largest hedge fund in the world. By the time he stepped down as Chief Investment Officer, CIO, in 2022, Bridgewater was managing more than $160 billion in assets from major clients like university endowments, public pension funds, and sovereign wealth funds. Dalio first became interested in investing as a teenager while he was caddying at a golf course. He started the job at the age of 12 in order to supplement the income he was already earning mowing lawns and shoveling snow from neighbors' driveways. The son of a jazz musician and homemaker living in the New York City borough of Queens, Dalio's job at the golf course brought him into contact with people The son of a jazz musician and homemaker living in the New York City borough of Queens, Dalio's job at the golf course brought him into contact with people. The son of a jazz musician and homemaker living in the New York City borough of Queens, Dalio's job at the golf course brought him into contact with powerful people who constantly talked about the booming stock market. He used $300 in savings to purchase his first shares in a company called Northeast Airlines, an investment that soon tripled in value after the firm was bought out in a merger. By the time he finished high school, Dalio had a portfolio worth several thousands of dollars, a significant sum for a young person in the 1960s. He enrolled in C.W. Post College, a branch of Long Island University, where he studied finance. Dalio continued to trade stocks as well as commodity futures, which earned him a considerable profit on a minimal investment, although he often struggled academically in high school. Dalio flourished in college as he pursued his own educational interests. After graduating with his bachelor's degree, he attended Harvard Business School to further his financial knowledge. Dalio also learned a lot while working as a clerk on the floor of the New York Stock Exchange, where he saw firsthand how global events can shape markets around the world. He also spent his summers at Merrill Lynch trading commodities, a niche interest that became a hot topic of conversation once he got back on campus. With help from a few enthusiastic classmates, Dalio founded Bridgewater Associates in 1975 to trade commodities, a rarity for Wall Street firms at the time. Although the business did not succeed initially, Dalio retained the name for later use. In the meantime, his knowledge of commodities was in high demand by numerous investment firms. Who had responded to a falling stock market by buying loads of commodities. The rigid structure of Wall Street wore away at Dalio, however, and he eventually left his steady job to go back into business for himself. At the age of 26, he relaunched Bridgewater out of his 2-bedroom New York City apartment, this time as a trading firm specializing in a diverse array of investments. Dalio began by advising corporate clients on currency exchanges, and interest rate risks, providing solid insights that increased his reputation among prominent investors. Bridgewater's big break came when it landed McDonald's as a client, followed soon after by the World Bank's multi-million-dollar pension fund. Managing these huge portfolios allowed Dalio to expand the scope of his investment, leading him to create an approach that he calls the global macro. This strategy focuses on investing on a large scale around the world on the basis of broad systemic factors like GDP growth, currency exchange rates, and commodity prices. Dalio proved the value of his concept after the 2008 financial crisis, which his firm weathered largely without incident, while many of his competitors struggled to stay afloat. Concentrating on the intricacies of the global macro has made Dalio a very rich man, with an estimated net worth around $20 billion. He also credits his success to the management concept of radical transparency, which encourages colleagues to offer and accept constructive criticism rather than gossiping behind one another's backs. Dalio is known for his philanthropic work as well, donating tens of millions of dollars to numerous causes over the decades. In 2011, he signed the Giving Pledge, a commitment by some of the world's wealthiest individuals to give the majority of their wealth. In 2011, he signed the Giving Pledge, a commitment by some of the world's wealthiest individuals to give the majority of their wealth to charity. Dalio's success shows how an early interest in finance can blossom over time into a multi-billion-dollar enterprise that affects the lives of people all over the world. To fully understand finance, you need to know the basics of securities markets, how they help businesses gain needed funding, and how investors like Ray Dalio can build their financial futures. In this chapter, you'll learn about how securities markets achieve both objectives. Sources: Ray Dalio, Hedge Fund Master, Academy of Achievement, achievement.org, October 11th, 2022. Andrew Ross Sorkin, Ray Dalio says, "If you worry, you don't have to worry." The New York Times, nytimes.com. November 20th, 2021. Juliet Chung, Bridgewater founder Ray Dalio, hands over control of firm. The Wall Street Journal, WSJ.com, October 4th, 2022. Benjamin Stupples, Ray Dalio warns SVB's collapse shows cracks widening in global finance. Bloomberg, Bloomberg.com, March 15th, 2023. Roy Rochlin and Getty Images Entertainment and Getty Images. Page 502. Name that company. If you were lucky and a family member paid $2,250 for 100 shares of this company when it went public in April 1965, your family would own 74,360 shares today, worth almost $20 million, after 12 stock splits and a 2% stock dividend. Name that company. Find the answer in the chapter. The function of securities markets, LO 19-1. Describe the roles of securities markets and of investment bankers. Securities markets, financial marketplaces for stocks, bonds, and other investments, serve two major functions. First, they assist businesses in finding long-term funding to finance capital needs, such as expanding operations, developing new products, or buying major goods and services. Second, they provide private investors a place to buy and sell securities investments, such as stocks and bonds, that can help them build their financial future. In this chapter, we look at securities markets first from the perspective of funding for businesses, and second as markets for private investors to buy and trade investments. Securities markets are divided into primary and secondary markets. Primary markets handle the sale of new securities. This is an important point to understand. Corporations make money on the sale of their securities, also called stock, only once, when they sell it on the primary market. The first public offering of a corporation stock is called an initial public offering, IPO. After that, the secondary market handles the trading of these securities between investors, with the proceeds of the sale going to the investor selling the stock, not to the corporation whose stock is sold. For example, imagine your restaurant. Harvest Gold has grown into a chain, and your products are available in many retail stores throughout the country. You want to raise additional funds to expand further. If you offer 1 million shares of stock in your company at $10 a share, you can raise $10 million at this initial offering. However, after the initial sale, if shareholder Jones decides to sell 100 shares of Harvest Gold stock to investor Smith, Harvest Gold collects nothing from that transaction. Smith buys the stock from Jones, not from Harvest Gold. It is possible, however, for companies like Harvest Gold to offer additional shares of stock for sale to raise additional capital. The Motley Fool, SOPA Images and Alamy stock photo. David and Tom Gardner, the Motley Fools, are passionate about spreading the message that securities markets can provide opportunities for all. The brothers have built their careers on providing high-quality financial information to investors regardless of education or income. Visit their website at fool.com for more information. As mentioned in Chapter 18, we can't overemphasize the importance of long-term funding to businesses. Given a choice, businesses normally prefer to meet their long-term financial needs by using retained earnings or borrowing. Given a choice, businesses normally prefer to meet their long-term financial needs by using retained earnings or borrowing funds either from a lending institution, bank, pension fund, insurance company, or corporate bond issue. However, if long-term funds are not available from retained earnings or lenders, a company may be able to raise capital by issuing corporate stock. Recall from Chapter 18 that selling stock in the corporation is a form of equity financing, and issuing corporate bonds is a form of debt financing. Visa's $18 billion IPO in 2008 was the largest U.S. IPO until Alibaba's $22 billion IPO in 2014. Saudi Aramco's $29 billion IPO became the world's largest IPO in 2019. These sources of equity and bond financing are not available to all companies, especially small businesses. Page 503. Let's imagine you need further long-term financing to expand operations at Harvest Gold. Your Chief Financial Officer, CFO, says the company lacks sufficient retained earnings and doesn't think it can secure the needed funds from a lending institution. She suggests that you offer shares of stock or issue corporate bonds to private investors to secure the funding. She warns, however, that issuing shares of stock or corporate bonds is not simple or automatic. To get approval for stock or bond issues, you must make extensive financial disclosures and undergo detailed scrutiny by the U.S. Securities and Exchange Commission, SEC. Because of these requirements, your CFO recommends that the company turn to an investment banker for assistance. Let's see why. The role of investment bankers. Investment bankers are specialists who assist in the issue and sale of new securities. These large financial firms can help companies like Harvest Gold prepare the extensive financial analyses necessary to gain SEC approval for bond or stock issues. Investment bankers can also underwrite new issues of stocks or bonds. That is, the investment banking firm buys the entire stock or bond issue at an agreed-on discount, which can be quite sizable, and then sells the issue to private or institutional investors at full price. Institutional investors are large organizations such as pension funds, mutual funds, and insurance companies that invest their own funds or the funds of others. Because of their vast buying power, institutional investors are a powerful force in securities markets. Before we look at stocks and bonds as long-term financing and investment opportunities in more depth, let's look at stock exchanges, the places where stocks and bonds are traded, and who regulates the industry. Stock exchanges, LO 19-2. Identify the stock exchanges where securities are traded. As the name implies, a stock exchange is an organization whose members can buy and sell exchange securities on behalf of companies and individual investors. The New York Stock Exchange, NYSE, was founded in 1792 and was then primarily a floor-based exchange, which means trades physically took place on the floor of the stock exchange. Things changed in 2005 when the NYSE merged with Archipelago, a securities trading company that specialized in electronic trades. 2 years later, it merged with Europe's Euronext exchange and became the NYSE Euronext. In 2013, the Intercontinental Exchange, ICE, located in Atlanta, purchased the NYSE Euronext for $8.2 billion. Today, the once active floor of the NYSE is largely symbolic. Most trading takes place on computers that can transact thousands of stock trades within seconds. While the crowd on the floor may seem sparse, it isn't deserted. In 2017, the NYSE changed its rules and allowed trading of all U.S. stocks, regardless of the exchange they are listed with on its historic floor. Prior to the change, only securities listed on the NYSE could be traded. Still, the bulk of the company's revenue comes from selling complex financial contracts and market data services to companies like Yahoo and Google that offer stock quotes as a service on their websites. Not all securities are traded on registered stock exchanges. The over-the-counter OTC market provides companies and investors with a means to trade stocks not listed on the large securities exchanges. The OTC market is a network of several thousand brokers who maintain contact with one another and buy and sell securities through a nationwide electronic system. Trading is conducted between two parties directly instead of through an exchange like the NYSE. Page 504. Ted Thigh and the Life Picture Collection and Getty Images. Spencer Platt and Getty Images. The NYSE was once the largest floor-based exchange in the world. For years, traders packed the floor to strike deals directly with other brokers. Today, stocks are bought and sold primarily on electronic networks. The photo on the right, showing the exchange floor, today seems deserted compared to the old days. The NASDAQ, originally known as the National Association of Securities Dealers Automated Quotations, was the world's first electronic stock market. It evolved from the OTC market, but is no longer part of it. The NASDAQ is an electronic-based network that links dealers so they can buy and sell. The NASDAQ is an electronic-based network that sells. The NASDAQ is an electronic-based network that links dealers so they can buy and sell securities electronically rather than in person. It is the largest U.S. electronic stock trading market and has more trading volume than any electronic exchange in the world. The NASDAQ originally dealt mostly with smaller firms, but today well-known companies such as Meta Platforms, Facebook, Microsoft, Intel, Google, and Starbucks trade their stock on the network. Adding a company to an exchange is a highly competitive undertaking, and the battle between the stock exchanges for a stock listing is often fierce. The competition has intensified with the entry of new exchanges such as the BATS Global Markets, now owned by CBOE Global Markets, and IEX exchanges, You can find the requirements for registering listing stocks on the NYSE and NASDAQ on their website at nyse.com and nasdaq.com. If a company fails to meet the listing requirements of an exchange, the stock can be delisted from the exchange. Securities regulations and the Securities and Exchange Commission, the Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the federal agency responsible for regulating the various stock exchanges. The Securities Act of 1933 helps protect investors by requiring full disclosure of financial information by firms selling bonds or stock. The U.S. Congress passed this legislation to deal with the free-for-all atmosphere that existed in the securities markets during the 1920s and the early 1930s that helped cause the Great Depression. The Securities and Exchange Act of 1934 created the SEC. Companies trading on the national exchanges must register with the SEC and provide it with annual updates. The 1934 Act also established specific guidelines that companies must follow when issuing financial securities, such as stocks or bonds. For example, before issuing either stocks or bonds for sale to the public, a company must file a detailed registration statement with the SEC that includes extensive economic and financial information. The condensed version of that registration document, called a prospectus, must be sent to prospective investors. The 1934 Act also established guidelines to prevent insiders within the company from taking advantage of privileged information they may have. Insider trading is using knowledge or information that individuals gain through their position that allows them to benefit unfairly from fluctuations in security prices. The key words here are benefit unfairly. Insiders within a firm are permitted to buy and sell stock in the company they work for, so long as Insiders within a firm are permitted to buy and sell stock in the company they work for, so long as they do not take unfair advantage of information unknown to the public. Page 505. Originally, the SEC defined the term insider rather narrowly as covering a company's directors and employees and their relatives. Today, the term has been broadened to include just about anyone with securities information not available to the general public. Let's say the CFO of Harvest Gold tells her next-door neighbor she is finalizing paperwork to sell the company to a large corporation, and the neighbor buys the stock based on this information. A court may well consider the purchase an insider trade. Penalties for insider trading can include hefty fines and imprisonment. For example, SAC Capital portfolio manager Matthew Martoma was convicted of insider trading in the largest insider trading scheme ever. He was sentenced to 9 years in prison, and the company paid $1.8 billion in fines. Look at Figure 19.1 and test your skill in identifying insider trading. Figure 19.1, is it insider trading or not? Insider trading involves buying or selling a stock on the basis of company information not available to the investing public. These hypothetical examples will give you an idea of what's legal and what's illegal. The answers are at the bottom of the figure. 1. You work with research and development at a large company and have been involved in a major effort that should lead to a blockbuster new product coming to the market. News about the product is not public, and very few other workers even know about it. Can you purchase stock in the company? 2. Pertaining to the situation in question 1, you are in a local coffee bar and mention to a friend about what's going on at the company. Another customer seated at an adjoining table overhears your discussion. Can this person legally buy stock in the company before the public announcement? 3. You work as an executive secretary at a major investment banking firm. You are asked to copy documents that detail a major merger about to happen that will keenly benefit the company being taken over. Can you buy stock in the company before the announcement is made public? 4. Your stockbroker recommends that you buy shares in a little-known company. The broker seems to have some inside information, but you don't ask any questions about his source. Can you buy stock in this company? 5. You work as a cleaning person at a major securities firm. At your job, you come across information from the trash cans and printers of employees of the firm that provide detailed information about several upcoming deals the firm will be handling. Can you legally buy stock in the companies involved? Answers: 1, no. 2, yes. 3, no. 4, yes. 5, no. Foreign stock exchanges. Thanks to expanded communications and the relaxation of many legal barriers, investors can buy securities from companies almost anywhere in the world. If you uncover a foreign company you feel has great potential for growth, you can purchase shares of its stock with little difficulty from U.S. brokers who have access to foreign stock exchanges. Foreign investors can also invest in U.S. securities and large foreign stock exchanges, like those in London and Tokyo, trade large amounts of U.S. securities daily. In addition to the London and Tokyo exchanges, other major stock exchanges are located in Shanghai, Sydney, Hong Kong, Sao Paulo, and Toronto. As global markets continue to expand, stock exchanges have become active in Africa. Page 506. Raising long-term funds using equity financing by issuing stock is an option many companies pursue. After the test prep, let's look in more depth at how firms raise capital by issuing stock. Test prep. What are the two primary purposes of a securities exchange? What does NASDAQ stand for? How does this exchange work? What government agency oversees the securities industry? What is a prospectus? How businesses raise capital by selling stock. LO 19-3. Compare the advantages and disadvantages of equity financing by issuing stock, and detail the differences between common and preferred stock. Stocks are shares of ownership in a company. A stock certificate represents stock ownership. It specifies the name of the company, the number of shared owners, it specifies the name of the company, the number of shares owned, and the type of stock it represents, discussed in the next section. Today, companies are not required to issue paper stock certificates to owners since stock is generally held electronically. Stock certificates sometimes indicate a stock's par value, which is a dollar amount assigned to each share of stock by the corporation's charter. Today, since par values do not reflect the market value of the stock, what the stock is actually worth, most companies issue stock with a very low par value or no par value. Dividends are part of a firm's profits that the company may but is not required to distribute to stockholders as either cash payments or additional shares of stock. Dividends are declared by a corporation's board of directors and are generally paid quarterly. Advantages and disadvantages of issuing stock. Some advantages to a firm of issuing stock include: as owners of the business, stockholders never have to be repaid their investment. There's no legal obligation to pay dividends to stockholders. Therefore, the firm can reinvest income, retained earnings, to finance future needs. Selling stock can improve the condition of a firm's balance sheet since issuing stock creates no debt. A corporation may also buy back its stock to improve its balance sheet and stock price and make the company appear stronger financially. Disadvantages of issuing stock include: as owners, stockholders usually only holders of common stock. As owners, stockholders have the right to vote for the company's board of directors. Typically, one vote is granted for each share of stock. Issuing new shares of stock can thus alter the control of the firm. Dividends are paid from profit after taxes and are not tax deductible. The need to keep stockholders happy can affect managers' decisions. Page 507. Companies can issue two classes of stock, common and preferred. Let's see how these two forms of equity financing differ. Issuing shares of common stock. Common stock is the most basic form of ownership in a firm. In fact, if a company issues only one type of stock, by law it must be common stock. Holders of common stock have the right to: 1. Elect members of the company board of directors and vote on important issues affecting the company, and 2. Share in the firm's profits through dividends, if approved by the firm's board of directors. Having voting rights in a corporation allows common stockholders to influence corporate policy because the board members they elect choose the firm's top management and make major policy decisions. Common stockholders also have a preemptive right to purchase new shares of common stock before anyone else. This allows common stockholders to maintain their proportional share of ownership in the company. Richard C.H. and Shutterstock. When the contact lens company Bosch plus Lomb issued its initial public offering (IPO), the company raised approximately $630 million from the sale. Can you see why issuing stock can be an appealing option for financing a company's growth? Issuing shares of preferred stock. Owners of preferred stock are given preference in the payment of company dividends and must be paid their dividends in full before any common stock dividends can be distributed, hence the term preferred. They also have a prior claim on company assets if the firm is forced out of business and its assets sold. But preferred stockholders have no voting rights in the company. Preferred stock may be issued with a par value that becomes the base for a fixed dividend the firm is willing to pay. Preferred stock may be issued with a par value that becomes the base for a fixed dividend the firm is willing to pay. For example, if a preferred stock's par value is $50 a share and its dividend rate is 4%, the dividend is $2 a share. An owner of 100 preferred shares receives a fixed yearly dividend of $200 if dividends are declared by the board of directors. Preferred stock can have other special features that common stock doesn't have. For example, it can be callable, which means preferred stockholders could be required to sell their shares back to the corporation. Preferred stock can also be converted to shares of common stock, but not the other way around. It can be cumulative, that is, if one or more dividends are not paid when promised. They accumulate, and the corporation must pay them in full at a later date before it can distribute any common stock dividends. Companies often prefer to raise capital by debt financing. One debt funding option frequently used by larger firms is issuing corporate bonds. Let's look at what's involved with issuing corporate bonds and how they differ from issuing stock. Test prep. Name at least 2 advantages and disadvantages of a company's issuing stock as a form of equity financing. What are the major differences between common stock and preferred stock? Page 508. How businesses raise capital by issuing bonds. LO 19-4. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds, and identify the classes and features of bonds. A bond is a corporate certificate indicating that an investor has lent money to a firm or a government. Organization that issues bonds has a legal obligation to make regular interest payments to investors and to repay the entire bond principal amount at a prescribed time. Let's further explore the language of bonds so you understand exactly how they work. Learning the language of bonds. Corporate bonds are usually issued in units of $1,000. Government bonds can be in much larger amounts. The principal is the face value, dollar value of a bond, which the issuing company is legally bound to repay in full to bondholder on the bond's maturity date. The principal is the face value, dollar value of a bond, which the issuing company is legally bound to repay in full to the bond holder on the bond's maturity date. Interest is the payment the bond issuer makes to the bond holders to compensate them for the use of their money. If Harvest Gold issues a $1,000 bond with an interest rate of 5% and a maturity date of 2030, it is agreeing to pay the bondholder a total of $50 interest each year until a specific. If Harvest Gold issues a $1,000 bond with an interest rate of 5% and a maturity date of 2030, it is agreeing to pay the bondholder a total of $50 interest each year until a specified date in 2030, when it must repay the full $1,000. If Harvest Gold issues a $1,000 bond with an interest rate of 5% and a maturity date of 2030, it is agreeing to pay the bondholder a total of $50 interest each year until a specified date in 2030, when it must repay the full $1,000. Maturity dates can vary considerably. Firms such as Disney, IBM, and Coca-Cola have issued so-called century bonds with 100-year maturity dates. Bond interest is sometimes called the coupon rate, a term that dates back to when bonds were issued as bearer bonds. The holder or bearer was considered the bond's owner. Back then, the company issuing the bond kept no record of changes in ownership. Bond interest was paid to whoever clipped coupons attached to the bond and sent them to the issuing company for payment. Today, bonds are registered to specific owners and changes in ownership are recorded electronically. The interest rate paid by U.S. government bonds influences the bond interest rate businesses must pay. U.S. government bonds are considered safe investments, so they can pay lower interest. Figure 19.2 describes several types of government bonds that compete with U.S. corporate bonds and securities markets. Bond interest rates also vary according to the state of the economy, the reputation of the issuing company, and the interest rate for bonds of similar companies. Though bond interest is quoted for an entire year, it is usually paid in 2 installments, and the rate generally cannot be changed. Figure 19.2 types of government securities that compete with corporate bonds. U.S. government bond, issued by the federal government, considered the safest type of bond investment. Treasury bill, T-bill, matures in less than a year, issued with a minimum denomination of $1,000. Treasury note, matures in 10 years or less, sold in denominations of $1,000 up to $1 million. Treasury bond, matures in 25 years or more, sold in denominations of $1,000 up to $1 million. Municipal bond, issued by states, cities, counties, and other state and local government agencies, usually exempt from federal taxes. Yankee bond, issued by a foreign government, payable in U.S. dollars. Page 509. Bond rating. Bond rating organizations assess. Bond rating organizations assess the credit worthiness of a corporation's bond issues. Independent rating firms such as Standard & Poor's, Moody's Investor Service, and Fitch Ratings rate bonds according to their degree of risk. Bonds can range from the highest quality to junk bonds, which we discuss later in the chapter. Figure 19.3 gives an example of the range of bond ratings issued by the ratings agencies. Figure 19.3, bond ratings, Moody's Investor Service, Standard & Poor's Rating Services, and Fitch Ratings. Bond rating agencies: Moody's, Standard & Poor's, Fitch Ratings. Descriptions. Advantages and disadvantages of issuing bonds. Bonds offer long-term financing advantages to an organization. Bondholders are creditors of the firm, not owners. They seldom vote on corporate matters, thus management maintains control over the firm's operations. Bond interest is a business expense and tax deductible to the firm. See Chapter 17. Bonds are a temporary source of funding. They're eventually repaid and the debt obligation is eliminated. Bonds can be repaid before the maturity date if they are callable. Bonds can also be converted to common stock. We discuss both features below. Bonds also have financing drawbacks. Bonds increase debt, long-term liabilities, and may adversely affect the market's perception of the firm. Paying interest on bonds is a legal obligation. If interest is not paid, bondholders can take legal action to force payment. The face value of the bond must be repaid on the maturity date. Without careful planning, this obligation can cause cash flow problems when the repayment comes due. Different classes of bonds. Corporations can issue two different classes of corporate bonds. Unsecured bonds, usually called debenture bonds, are not backed by any specific collateral, such as land or equipment. Only firms with excellent reputations and credit ratings can issue debenture bonds due to the lack of security they provide investors. Secured bonds, sometimes called mortgage bonds, are backed by collateral, such as land or buildings, that is pledged to bondholders if interest or principal isn't paid when promised. A corporate bond issuer can choose to include different bond features. Let's look briefly at some special features. Page 510. Special bond features. By now you should understand that bonds are issued with an interest rate, are unsecured or secured by some type of collateral, and must be repaid at their maturity date. This repayment requirement often leads companies or governments to establish a reserve account called a sinking fund. Its primary purpose is to ensure that enough money will be available to repay bondholders on the bond's maturity date. Firms issuing sinking fund bonds periodically retire, set aside some part of the principal they owe prior to maturity so that enough funds will accumulate by the maturity date to pay off the bond. Sinking funds are generally attractive to both issuing firms and investors for several reasons. They provide for an orderly retirement repayment of a bond issue. They reduce the risk the bond will not be repaid. They reduce the risk the bond will not be repaid. They support the market price of the bond because they reduce the risk the bond will not be paid. A callable bond permits the bond issuer to pay off the bond's principal before its maturity date. This gives companies some discretion in their long-term financing forecasting. Suppose Harvest Gold issued $10 million in 20-year bonds at 10% interest. Its yearly interest expense is $1 million. $10 million times 10%. If market conditions change and bonds of the same quality now pay only 7%, Harvest Gold will be paying 3%, or $300,000, $10 million times 3%, in excess interest yearly. The company could benefit by calling in, paying off the old bonds, and issuing new bonds at the lower rate. If a company calls a bond before maturity, it often pays investors a price above the bond's face value. Investors can convert convertible bonds into shares of common stock in the issuing company. This can be an incentive for an investor because common stock value tends to grow faster than a bond. Therefore, if the value of the firm's common stock grows sizably over time, bondholders can compare the value of continued bond interest earned with the potential profit of a specified number of shares of common stock into which the bonds can be converted. Now that you understand the advantages and disadvantages of stocks and bonds as a long-term financing tool from a company's perspective, let's explore the opportunities stocks, bonds, and other securities provide for investors. First, though, check your understanding with the test prep questions. Test prep. Why are bonds considered a form of debt financing? What does it mean if a firm issues a 7% debenture bond due in 2030? Explain the difference between an unsecured and a secured bond. What are convertible bonds Why are convertible bonds attractive to investors? How investors buy securities. LO 19-5. Explain how to invest in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. Investing in stocks and bonds is not difficult. First, you decide what stock or bond you want to buy. After that, you find a brokerage firm authorized to trade securities to execute your order. A stockbroker is a registered representative who works for a brokerage firm as a market intermediary to buy and sell securities for clients. Stockbrokers place an order and negotiate a price. After the transaction is completed, the trade is reported to your broker, who notifies you. Today, large brokerage firms maintain automated order systems that allow brokers to enter your order the instant you make it. The order can be confirmed in seconds. A stockbroker can also be a source of information about what investments would best meet your financial A stockbroker can also be a source of information about what investments would best meet your financial objectives. However, it's still important to learn about stocks and bonds on your own, since stockbrokers' advice may not always meet your specific expectations and needs. Today, some investors are taking advantage of having their investment decisions being managed by independent advisors. The adapting to change box, however, raises questions about the influence of outside issues on investment markets. Page 511. Adapting to change. What's the controversy over ESG investing all about? A controversy about ESG investing has been swirling among investors, investment companies, and the governments recently. A controversy about ESG investing has been swirling among investors, investment companies, and the government recently. So what is ESG investing? ESG is an acronym that means environmental, social, and governance. Investors involved in ESG investing consider companies' records on environmental issues, relationships with people within and outside. ESG is an acronym that means environmental, social, and governance. Investors involved in ESG investing consider companies' records on environmental issues, relationships with people within and outside the organization, and how the company is managed, like, for example, executive compensation tied to performance, etc. ESG investing today accounts for $1 every $8. ESG investing today accounts for $1 of every $8 of U.S. assets under professional money management. Critics claim that ESG investing invites political issues into the investing process, like, for example, forcing companies to adopt expensive environmental controls that affect the bottom line and therefore shareholder value. Supporters counter that ESG investing identifies companies that could be riskier to invest in, for example, tobacco or gun manufacturers who could be liable for massive lawsuits. ESG investors are encouraging stronger involvement with companies concerning involvement in environmental, social, and governance issues. More and more ESG investors are also casting votes at company meetings with ESG issues as their primary focus. Corporate America was stunned when ESG investors convinced several large investment firms to vote to replace 3 directors on ExxonMobil's board, citing a push for a decarbonized world. Some funds have since pledged not to invest in any companies considered risky or dangerous to society, like, for example, tobacco companies or gun manufacturers. Others agreed to invest only in firms that rate high on ESG scores. D.EE_Angelo and Shutterstock. Environment, social governance. Many business leaders, investors, and politicians have been highly critical of the demands of ESG. Business leaders are especially agitated by ratings evaluated by the S&P 500 ESG index. Politicians are claiming that ESG is politicizing investing and changing the role of pension funds. Another issue seems to surround the requirement of investment firms pursuing the best interests of investors. If an advisor is a registered investment advisor, RIA, they are required to follow a fiduciary standard of advice, meaning the client's interest must always be placed ahead of anything else. In spite of the controversy, it's likely ESG investing's impact on the investment markets will continue well into the future. Sources: what is environmental, social, and governance ESG investing? Investopedia, investopedia.com. March 22nd, 2023. Stan Cho in the Associated Press. Congress has declared woke ESG investing. What is ESG and why do some hate it so much? Fortune, fortune.com. March 1st, 2023. Mark Edlison and Andy Puzder. Is ESG profitable? The numbers don't lie. The Wall Street Journal, WSJ.com. March 10th, 2023. Michael Posner. How to make ESG investing real and meaningful. Forbes, Forbes.com. January 25th, 2023. Lauren Foster. How top ESG funds beat the market. Barron's, Barron's.com. January 20th, 2023. Darren Fonda. Companies are under siege in the culture wars. How they're fighting back. The Wall Street Journal, WSJ.com. May 3rd, 2023. Investing through online brokers. Investing through online brokers. Investors can also choose from multiple online trading sources to buy and sell stocks and bonds. Charles Schwab, Interactive Brokers, and Fidelity are the leaders. Investors who trade online are willing to do their own research and make investment decisions without the direct assistance of a broker. This allows online brokers the ability to charge zero trading fees. The leading online The leading online services do provide important market information, such as company financial data, price histories of a stock, and analysts' reports. Often, the level of information services you receive depends on the size of your account and your level of trading. Often, the level of information services you receive depends on the size of your account and your level of trading. Robo-advisors are automated online tools that use advanced algorithms to make investment suggestions, manage money, rebalance a client's portfolio, and perhaps even shift investments to save taxes. With robo-investing, you tell the robots your risk tolerance and your financial goals, and the rest is handled by the robo-advisor's algorithms. In general, your account is invested in conservative exchange-traded funds, ETFs, and high-rated bond issues. However, the robo-advisor will rebalance your account and make beneficial trades to help minimize taxes. Many robo-advisors charge no fees for the first $10,000 invested, and then 0.5 to 0.25% on all investments after that. Traditional advisors often charge over 1% annually. It's fair to say that robo-advisors cannot do all of the same work that human financial professionals can do. Human financial managers, especially certified financial planners, CFPs, are well schooled in estate planning, mortgage refinancing, and trust investments, as well as personal issues such as planning your children's education. Whether you decide to use an online broker or to invest through a traditional stockbroker, remember that investing means committing your money with the hope of making a profit. The dot-com bubble in the early 2000s, the financial crisis that began in 2008, and the COVID-19 pandemic in 2020 proved again that investing is a risky business. Therefore, the first step in any investment program is to analyze your level of risk tolerance. Other factors to consider include your desired income, cash requirements, and need to hedge against inflation, along with the investment's growth prospects. The Making Ethicals decision box describes an interesting personal stock investment decision. Page 512. Making ethical decisions. Invest or let profits go up in smoke. You recently received news your Uncle Alex passed away after a long battle with lung cancer. To your surprise, he left you $25,000 in his will, saying you were his favorite relative. You remember your uncle as a hardworking man who loved baseball and liked nothing better than to watch you pitch for your college team. Unfortunately, he started smoking as a young man and became a heavy chain smoker. His doctor said that smoking was the primary cause of his lung cancer. After receiving the inheritance, you wonder where to invest the money. Your old teammate, Les, a financial advisor, recommends that you buy stock in a well-known multinational firm that offers a good dividend and has solid global growth potential. Les tells you the firm's major revenue producer is tobacco and vaping products, but assures you it has other products as well. You know Les has your best interest at heart. You also believe your uncle would like to see the money he left you grow. However, you wonder if a company that markets tobacco products is an appropriate place to invest your inheritance. What are the ethical alternatives in this situation? What are the consequences of the alternatives? What will you do? You are never too young or too old to invest, but you should first ask questions and consider investment alternatives. Let's take a look at several strategies. Choosing the right investment strategy. Choosing the right investment strategy. Investment objectives change over the course of a person's life. A younger person can better afford to invest in high-risk investment options, such as stocks, than can a person nearing retirement. Younger investors generally look for significant growth in the value of their investments over time. If stocks go into a tailspin and decrease in value, as they did in 2008, by 20%, a younger person has time to wait for stock values to rise again, as they did in 2022. Older people, perhaps on a fixed income, lack the luxury of waiting and may be more inclined to invest in bonds that offer a steady return as a protection against inflation. Page 513. Consider 5 key criteria when selecting investment options. 1. Investment risk, the chance that an investment will be worth less at some future time than it's worth now. 2. Yield, the expected return on an investment such as interest or dividends, usually over a period of 1 year. 3. Duration, the length of time your money is committed to an investment. 4. Liquidity, how quickly you can get back your invested funds in cash if you want or need them. 5. Tax consequences, how the investment will affect your tax situation. What's important in any investment strategy is the risk and return trade-off. Setting investment objectives such as growth, choosing stocks you believe will increase in price, choosing stocks you believe will increase in price, or income. Setting investment objectives such as growth, choosing stocks you believe will increase in price, or income, choosing bonds that pay consistent interest or stocks that pay high dividends, should set the tone for investment strategy. Setting investment objectives such as growth or income should set the tone for investment strategy. Reducing risk by diversifying investments. Diversification involves buying several different types of investments to spread the risk of investing. An investor may put 25% of their money into U.S. stocks that have relatively high risk but strong potential growth. An investor may put 25% of their money into U.S. stocks that have relatively high risk but strong growth potential, another 25% in conservative government bonds, 25% in dividend-paying stocks that provide income, 10% in an international mutual fund, discussed later, and the rest in the bank for emergencies and other possible investment opportunities. By diversifying with such a portfolio strategy or allocation model, investors decrease the chance of losing everything they have invested. Both stockbrokers and certified financial planners, CFPs, are trained to give advice about the investment portfolio that would best fit each client's financial objectives. However, the more investors themselves read and study the investment market, the higher their potential for gain. However, the more investors themselves read and study the investment market, the higher their potential for gain. A short course in investments can also be useful. Today, many investors prefer to trust their money to a fiduciary. According to the National Association of Personal Financial Advisors, NAPFA, fiduciary advisors always act in the best interest of their clients and must disclose any possible conflicts of interest that might impact their clients. Stocks and bonds are investment opportunities individuals can use to enhance their financial future. Before we look at investing in stocks and bonds in more depth, let's check your understanding with the test prep. Test prep. What is the key advantage of investing through online brokers? What is the primary disadvantage? What are 3 key factors to remember in establishing your investment strategy? What is the primary purpose of diversifying investments? What is the major benefit of investing with a fiduciary? Investing in stocks, LO 19-6. Analyze the opportunities stocks offer as investments. Buying stock makes investors part owners of a company. This means that As stockholders, they can participate in its success. Unfortunately, they can also lose money if a company does not do well or the overall stock market declines. Stock investors are often called bulls or bears, according to their perceptions of the market. Bulls believe that stock prices are going to rise. They buy stock in anticipation of the increase. A bull market is when overall stock prices are rising. Bears expect stock prices to decline and sell their stocks in anticipation of falling prices. That's why when stock prices are declining, the market is called a bear market. Page 514. The market price and growth potential of most stock depends heavily on how well the corporation is meeting its business objectives. A company that achieves its objectives offers great potential for capital gains. The positive difference between the price at which you bought a stock and what you sell it for. For example, an investment of $2,250 in 100 shares of McDonald's when the company first offered its stock to the public in April 1965 would have grown to 74,360 shares after the company's 12 stock splits and 2% stock dividend, worth almost $20 million as of the market close on March 2nd, 2023. Now that's a lot of Big Macs and Happy Meals. Investors often select stocks depending on their investment strategy. Stocks issued by higher quality companies such as Coca-Cola, Johnson & Johnson, and IBM are referred to as blue chip stocks, a term derived from poker where the highest value chip was the blue chip. The stock generally pay regular dividends and experience consistent price appreciation. Stocks of corporations in emerging fields such as technology, biotechnology, or internet-related firms whose earnings are expected to grow at a faster rate than other stocks are preferred to as stocks of corporations in emerging fields such as technology, biotechnology, or internet-related firms whose earnings are expected to grow at a faster rate than other stocks are referred to as growth stocks. While riskier, growth stocks may offer the potential for higher returns. Stocks of public utilities are considered income stocks because they usually offer investors a high dividend yield that generally keeps pace with inflation. There are even penny stocks representing ownership in companies that compete in high-risk industries like oil exploration. Penny stocks sell for less than $2. Some analysts say less than $5, and are considered very risky investments. When purchasing stock, investors have choices when placing orders to buy. A market order tells a broker to buy or sell a stock immediately at the best price available. A limit order tells the broker to buy or sell a stock at a specific price if that price becomes available. Let's say a stock is selling for $60 a share. You believe the price will eventually go higher, but could drop to $52 first. You can place a limit order at $52, so your broker will buy the stock at $52 if it drops to that price. If the stock never falls to $52, the broker will not purchase it for you. Stock splits. Higher per share prices can induce companies to declare stock splits, in which they issue 2 or more shares for every one that's outstanding. If Harvest Gold stock were selling for $100 a share, the firm could declare a 2-for-1 stock split. Investors who owned 1 share of Harvest Gold would now own 2, each worth only $50, half as much as before the split. Stock splits cause no change in the firm's ownership structure and no immediate change in the investment's value. Investors generally approve of stock splits, however, because they believe demand for a stock may be greater at $50 than $100, and the price may then go up in the near future. Some stock splits can be massive. Both Amazon and Alphabet, owner of Google, split their stocks 20-for-1 in 2022. Tesla had 2-for-1 stock splits in 2021 through 2022. Apple split its stock 4-for-1 in 2020. Some companies never split their stock. Legendary investor Warren Buffett's firm, Berkshire Hathaway, has never split its Class A stock, even when its per-share price surpassed $470,000. Buying stock on margin. Buying stock on margin means borrowing some of the stock's purchase cost from the brokerage firm. The margin in the portion of the stock's purchase price that investors must pay with their own money. The Board of Governors of the Federal Reserve System sets margin rates in the U.S. market. Briefly, if the margin rate is 50%, an investor who qualifies for a margin account may borrow up to 50% of the stock's purchase price from the broker. Although buying on margin might sound like an easy way to buy more stocks, the downside is that investors must repay the credit extended by the broker plus interest. If the investor's account goes down in value, the broker may issue a margin call, requiring the investor to come up with funds to cover the losses the account has suffered. If the investor is unable to fulfill the margin call, the broker can legally sell off shares of the investor's account to reduce the broker's chance of loss. Margin calls can force an investor to repay a significant portion of their account's loss within days or even hours. Buying on margin is thus a risky way to invest in stocks. Page 515. John Angelillo and UPI and Alamy stock photo. Welcome Airbnb to the NASDAQ family. Airbnb, NASDAQ. Rent-O, New York, NYPD. All in NYC. If you stroll through Times Square in New York City, you never have to wonder how stocks are performing on the NASDAQ exchange. The NASDAQ price wall continuously updates prices and the number of shares being traded. Originally, the NASDAQ dealt primarily with small companies. Today, it competes with NYSE for new stock listings. Understanding stock quotations. Publications like the Wall Street Journal, Barron's, and Investors Business Daily carry a wealth of information concerning stocks and other investments. Your local newspaper may carry similar information as well. Financial websites like MSN Money, Yahoo Finance, and CNBC carry up-to-the-minute information about companies that is much more detailed and only a click away. Take a look at Figure 19.4 to see an example of a stock quote from MSN Money for Microsoft. Microsoft trades on the NASDAQ exchange under the symbol MSFT. Preferred stock is identified by the letters PF following the company symbol. Remember, corporations can have several different preferred stock issues, but only one common stock issue. Figure 19.4, Understanding Stock Quotations. Microsoft Corporation, MSFT, NASDAQ GS, real-time price currency in USD. Stock price is $284.61. As of 9:33 a.m. Eastern Standard Time on that particular day. It went up $1.12. plus 0.40%. The information provided in the quote is easy to understand. It includes the highest and lowest price the stock traded for that day, the stock's high and low over the past 52 weeks, the dividend paid, if any, the stock's dividend yield, annual dividend as a percentage of the stock's price per share, important ratios like the price and earnings, P and E ratio, the price of the stock dividend, the price of the stock divided by the firm's per share earnings, and the earnings per share. Investors can also see the number of shares traded, which is also known as volume, and the total market capitalization of the firm. More technical features such as the stock's beta, which means the degree of the stock's risk, may also appear. Figure 19.4 illustrates the stock's intraday trading throughout the current day, but you can also click to see charts for different time periods. Similar information about bonds, mutual funds, and other investments is also available online. Page 516. You might want to follow the market behavior of specific stocks that catch your interest, even if you lack the money to invest in them. Many successful investors started in college by building hypothetical portfolios of stocks and tracking their performance. The more you know about investing before you actually risk your money, the better. The developing career skills and putting principles to work features at the end of this chapter have exercises you can use for practice. Investing in bonds, LO 19-7. Analyze the opportunities bonds offer as investments. Investors looking for guaranteed income and limited risk often turn to U.S. government bonds for a secure investment. These bonds have the financial backing and full faith and credit of the United States government. Municipal bonds are offered by local governments and often have advantages such as tax-free interest. Some may even be insured. Corporate bonds are a bit riskier and more challenging. First-time corporate bond investors often ask two questions. The first is, if I purchase a corporate bond, do I have to hold it until the maturity date? No, you do not. Bonds are bought and sold daily on major securities exchanges, the secondary market we discussed earlier. However, if you decide to sell your bond to another investor before its maturity date, you may not get its face value. If your bond does not have features that make it attractive to other investors, like a high interest rate or early maturity, you may have to sell at a discount, that is, a price less than the bond's face value. But if other investors do highly value it, you may be able to sell your bond at a premium, a price above its face value. Bond prices generally fluctuate inversely with current market interest rates. This means as interest rates go up, bond prices fall and vice versa. Like all investments, however, bonds have a degree of risk. The second question is, how can I evaluate the investment risk of a particular bond issue? Standard & Poor's, Moody's Investor Service, and Fitch Ratings rate the risk of many corporate and government bonds. Look back at figure 19.3. In evaluating the ratings, recall the risk and return trade-off. The higher the risk of a bond, the higher the interest rate of the issuer of the bond must offer. The higher the risk of a bond, the higher the interest rate the issuer of the bond must offer. Investors will invest in a bond considered risky only if the potential return interest is high enough. In fact, some will invest in bonds considered junk, discussed in the next section. The adapting to change box highlights a situation where taxpayers may be paying off bonds for a standard. The adapting to change box highlights a situation where taxpayers may be paying off bonds for a stadium minus a football team. Page 517. Adapting to change, Bears, bonds, business, and football. The Chicago Bears have been a mainstay of the Chicago sports scene since 1921. From 1921 until 1971, the Bears played their home games at Wrigley Field in Chicago. Since 1971, the team has called Soldier Field its home. But today, the team seems to be embarking on a new course. The Bears have spent $197 million to purchase the 326-acre Arlington International Racecourse site as a possible new home for the Bears that would include a new enclosed stadium and massive entertainment and residential development. The team is also thinking of the potential of hosting major events such as Super Bowl and NCAA basketball championship. The Bears' dream of the Arlington Heights development has likely been influenced by SoFi Stadium in Inglewood, California. SoFi is the home of the Los Angeles Rams after moving from St. Louis. That is now the palace of the National Football League. While the move to Arlington is by no means a done deal, as of this writing, questions about the impact of the Bears' move is a hot While the move to Arlington is by no means a done deal, as of this writing, questions about the impact of the Bears' move is a hot topic in Chicago. One of the key questions involves the future use of Soldier Field. Another, perhaps more important question facing Chicago in the immediate future is, what about the bond funding for the renovation of Soldier Field that taxpayers assumed in 2023? Christopher Arndt and iStock Unreleased and Getty Images. Soldier Field. One thing is definite, whether the Bears leave for a new stadium or not, taxpayers are still on the hook for paying for the 2003 renovation Soldier Field. Taxpayers are still on the hook for paying for the 2003 renovation of Soldier Field that was meant to keep the Bears there. Unfortunately, after years of paying only interest and not paying down the principal, the original debt has blown up from $399 million to $631 million, according to the Illinois Sports Facility Authority that manages the bonds. The bonds were to be funded through a 2% portion of the city's hotel tax, and concern has grown about whether the tax can cover costs. Interest payments increased to $55 million this year and will skyrocket to $90 million by 2032. Regardless of where the Bears play their games, the debt has to be repaid. The expense to the team is zero. The Bears' move to a new stadium in Arlington is by no means certain. However, one factor looms large. The Bears plan to pay for the new stadium itself, while public investment will be needed for the surrounding infrastructure, such as roads and drainage, issues that municipalities often will negotiate. Stay tuned for more kickoff surprises. Sources: Chicago Bears and Arlington Heights. What to know about the stadium move from Soldier Field. Chicago Tribune, Tribune.com, March 22nd, 2023. Ryan Taylor, is Chicago Parks District ready for Bears to leave Soldier Field? Chicago Sports, April 4th, 2023. Robert McCoppin. Whether the Chicago Bears leave or not, taxpayers are on the hook for growing Soldier Field debt payments. Chicago Tribune, Tribune.com, March 14th, 2023. Jeremy Schoen, The new Chicago Bears Arlington Heights Stadium will benefit Chicagoland. The Evanstonian.com, March 15, 2023. Investing in high-risk junk bonds. Although bonds are considered relatively safe investments, some investors look for higher returns through riskier high-yield bonds called junk bonds. Standard & Poor's, Moody's Investor Service, and Fitch Ratings define junk bonds as those with high risk and high default rates. Junk bonds pay investors interest as long as the value of the company's assets remains high and its cash flow stays strong. Although the interest rates are attractive and often tempting, if the company can't pay off the bond, the investor is left with an investment that isn't worth more than the paper it's written on. In other words, junk. Investing in mutual funds and exchange-traded funds. LO 19-8 explain the investment opportunities in mutual funds and exchange-traded funds, ETFs. A mutual fund buys stocks, bonds, and other investments and then sells shares in those securities to the public. A mutual fund is like an investment company that pools investors' money and then buys stocks or bonds, for example, in many companies in accordance with the fund's specific purpose. Mutual fund managers are specialists who pick what they consider to be the best stocks and bonds available and help investors diversify their investments. Page 518. Mutual funds range from very conservative funds that invest only in government securities to others that specialize in emerging biotechnology firms, internet companies, foreign companies, precious metals, and other investments with greater risk. Some funds will have a mix of investments, like stocks and bonds. The size of the mutual fund industry today is staggering, as is the number of different types of funds available. Figure 19.5 lists just a small sample of some of the mutual fund investment options investors can select. Figure 19.5 Mutual fund objectives. Mutual funds have a wide array of investment categories. They range from low-risk, conservative funds to others that invest in high-risk industries. Listed here are abbreviations of funds and what these abbreviations stand for. AB, investment grade corporate bonds. AU, gold oriented. BL, balanced. EI, equity income. EM, emerging markets. EU, European region. GL, global. GM, general municipal bond. GT, general tax bonds. HB, health, biotech. HC, high yield bonds. HM, high yield municipal bonds. IB, intermediate term corporate bonds. IG, intermediate term government bonds. IL, international. IM, intermediate term municipal bonds. LC, large gap core. LG, large gap growth. LT, Latin America. LU, long-term U.S. bonds. LV, large cap value. MC, mid-cap core. MG, mid-cap growth. MP, stock and bond fund. MT, mortgage securities. MV, mid-cap value. NM, insured municipal bonds. NR, natural resources. PR, Pacific region. SB, short-term corporate bonds. SC, small cap core. SE, sector funds. SG, small cap growth. SM, short-term municipal bonds. SP, S&P 500. SQ, specialty. SS, single state municipal bonds. SU, short-term government bonds. SV, small cap value. TK, science and technology. UN, unassigned. UT, utility. WB, world bonds. XC, multi-cap core. XG, multi-cap growth. XV, multi-cap value. Sources: The Wall Street Journal and Investors Business Daily. At one time, young or new investors were advised to buy a tape of mutual fund called index fund. Index funds are constructed to match or track the components of a market index, such as the Standard and Poor's 500, S&P 500. The S&P 500 includes 500 leading companies and is considered the best market gauge. The S&P 500 includes 500 leading companies and is considered the best market gauge of large cap stocks. Index funds are very low cost, easy to obtain, and can be held by investors for a long period of time. Index funds have also matched or beat the performance of higher priced funds managed by professional money managers. Today, index funds are recommended for all levels of investors. An index fund may focus on large companies, small companies, emerging countries, or real estate investment trusts, or REITs. One way to diversify your investments is by investing in a variety of index funds. A stockbroker, certified financial planner, CFP, or banker can help you find the option that best fits your investment objectives. The Morningstar Investor newsletter is a good resource for evaluating mutual funds and index funds, as are business publications such as Bloomberg Business Week, Fortune, The Wall Street Journal, Forbes, Barron's, Investors, Business Daily, and many others. With mutual funds, it's simple to change your investment objectives if your financial objectives change. For example, moving your money from a bond fund to a stock fund is no more difficult than making a phone call, clicking a mouse, or tapping your cell phone. Another advantage of mutual funds is that you can generally buy directly from the fund and avoid broker fees or commissions. It's important to check the long-term performance of the fund's managers. The more consistent the performance of the fund's management, the better. Also check for fees and charges of the mutual fund because they can differ significantly. A load fund, for example, charges investors a commission to buy or sell its shares. A no-load fund charges no commission. Mutual funds, called open-end funds, will accept the investments of any interested investors. Mutual funds, called open-end funds, will accept the investments of any interested investors. Closed-end funds, however, limit the number of shares. Once the fund reaches its target number, no new investors can buy into the fund. Exchange-traded funds, ETFs, resemble both stocks and mutual funds. They are collections of stocks, bonds, and other investments that are traded on securities exchanges but are traded more like individual stocks than like mutual funds. Mutual funds, for example, permit investors to buy and sell shares only at the close of the trading day. ETFs can be purchased or sold at any time during the trading day, just like individual stocks. The number of exchange-traded funds has exploded over the past 15 years. According to Morningstar, there are now 3,200 U.S. listed varieties of ETFs with $7 trillion invested. The key points to remember about mutual funds and ETFs is that they offer small investors a way to spread the risk of owning stocks, bonds, and other securities, and have their investments managed by a financial specialist for a fee. Financial advisors put mutual funds and ETFs high on the list of recommended investments, particularly for small or first-time investors. Figure 19.6 evaluates bonds, stocks, mutual funds, and ETFs according to risk, income, and possible investment growth, capital gain. Page 519. Figure 19.6, comparing investments. Investment, degree of risk, expected income, possible growth, capital gain. Investment, bonds, preferred stock, common stock, mutual funds, ETFs. Degree of risk, low, medium, high, medium. Expected income, secure, steady, variable, possible growth, capital gain, little, good. So when you compare Bonds, the degree of risk is low, the expected income is secure, possible growth, capital gains little. When you compare preferred stock, the degree of risk is medium, expected income is steady, possible growth, capital gain is little. When you compare common stock, the degree of risk is high, expected income is variable, possible growth, capital gain is good. When you compare mutual funds, the degree of risk is medium, expected income is variable, possible growth, capital gain is good. When you compare ETFs, the degree of risk is medium, expected income is variable, possible growth, capital gain is good. Test prep. What is a stock split? Why do companies sometimes split their stock? What does buying stock on margin mean? What are mutual funds and ETFs? How are they different? What is a load and no load mutual fund? What is the key benefit to investors in investing in a mutual fund or ETF? Page 520, Understanding Stock Market Indicators, LO 19-9. Describe how indicators like the Dow Jones Industrial Average affect the market. Investors today have an enormous wealth of investment information available to them. Newspapers like the Wall Street Journal, Barron's, and Investors Business Daily provide vast amounts of information about companies and global markets. Television networks like MSNBC and CNBC offer daily investment analyses and different viewpoints to assist investors. Websites like MSN, Money, and Yahoo Finance offer financial information to investors free of charge that not long ago was available only to brokers for a hefty fee. But keep in mind that investing is an inexact science. Every time someone sells a stock believing it will fall, someone else is buying it, believing its price will go higher. You often hear business news reports include a comment like, "The Dow was up 190 points today in active trading." Ever wonder what that's all about? The Dow Jones Industrial Average, the Dow, is the average cost of the Dow Jones Industrial Average, the Dow, is the average cost of 30 selected industrial stocks. The financial industry uses it to give an indication of the direction, up or down, of the stock market over time. Charles Dow began the practice of measuring stock averages in 1884 using the prices of 12 key stocks. In 1982, the Dow was broadened to include 30 stocks. The 12 original and 30 current stocks in the Dow are illustrated in figure 19.7. Do you recognize any of the 12 original companies? Figure 19.7, the original Dow and current Dow. The original Dow 12, the 30 current Dow companies. The original Dow 12, American Cotton Oil, American Sugar Refining Company, American Tobacco, Chicago Gas, Distilling and Cattle Feeding Company, General Electric Company, Laclede Gaslight Company, National Lead, North American Company, Tennessee Coal, Iron and Railroad Company, U.S. Leather, U.S. Rubber Co., the 30 current Dow companies, American Express, J.P. Morgan Chase, Amgen, McDonald's, Apple, Merck, Boeing, Microsoft, Caterpillar, 3M, Chevron, Nike, Cisco, Procter & Gamble, Coca-Cola, Salesforce, Dow, Travelers, Goldman Sachs, United Health Group, Home Depot, Verizon, Honeywell, Visa, IBM, Walmart Incorporated, Intel, Walt Disney, Johnson & Johnson, Walgreens, Boots Alliance. Today, Dow Jones and Company substitutes new stocks in the Dow when it's deemed appropriate. In 1991, Disney was added to reflect the increased economic importance of the service sector. In 1999, the Dow added Home Depot and SBC Communications, along with its first NASDAQ stocks, Intel and Microsoft. In 2013, Visa, Goldman Sachs, and Nike replaced Alcoa, Bank of America, and Hewlett-Packard in 2015. Apple replaced AT&T. In 2018, Walgreens Boots Appliance replaced General Electric. Page 521. Critics argue that the 30-company Dow sample is too small to get a good statistical representation of the direction of the market over time. Many investors and analysts prefer to follow stock indexes like the Standard & Poor's 500, S&P 500, which tracks the performance of 500 companies. Staying abreast of the market will help you decide what investments seem most appropriate to your needs and objectives. Remember two key investment realities. Your personal financial objectives and needs change over time, and markets can be rewarding but also can be volatile. Let's take a look at a short history of market volatility and how the securities industry responded to the challenges. Riding the market's roller coaster. Throughout the 1900s, the stock market had its ups and downs, spiced with several major tremors. The first major crash occurred on Tuesday, October 29, 1929, called Black Tuesday, when the stock market lost almost 13% of its value in a single day. This day and the deep depression that followed reinforced the reality of market volatility, especially to those who bought stocks heavily on margin. On October 19, 1987, the stock market suffered the largest one-day drop in its history, losing over 22% of its value. On October 27, 1997, investors again felt the market's fury. Fears of an impending economic crisis in Asia caused panic and widespread losses. Luckily, the market regained its strength after a short downturn. After regaining strength in the late 1990s, the market again suffered misfortune in the early 2000s. All told, investors lost $7 trillion in market value from 2000 through 2002 due to the burst of the tech stock bubble. A recovery that started in the mid-2000s was cut short in 2008 when the financial crisis fueled and massive exodus from the stock market, resulting in record losses. The Great Recession followed. In 2019, the COVID-19 pandemic wreaked havoc on the stock market as businesses were forced to stop operations due to the spread of the pandemic. What caused the market turmoil of 1987, 1997, 2000 through 2022, 2008, and 2019? In 1987, many analysts agreed it was program trading, in which investors give their computers instructions to sell automatically to avoid potential losses if the price of their stock dips to a certain point. On October 19, 1987, computers sell orders caused by many stocks to fall to unbelievable depth. The crash prompted the U.S. exchanges to create mechanisms called curbs and circuit breakers to restrict program trading whenever the market moves up or down by a large number of points in a trading day. A key computer is turned off and program trading is halted. If you watch programming on CNBC or MSNBC, you'll see the phrase curbs in appear. If you watch programming on CNBC or MSNBC, you'll see the phrase curbs in appear on the screen. Via Val Tours and Shutterstock, investing in the stock market has never been for the faint of heart. The market seems to have continuous steep climbs and sharp falls. Do you have the risk tolerance to survive the wild market swings? Circuit breakers are more drastic than curbs and are triggered when the Dow falls 10, 20, or 30% in a day. That happened on October 27, 1997, when the market suffered an approximate 7% decline and the market closed for the day at 3:30 p.m. instead of 4 p.m. Many believe the 1997 market drop caused by the financial crisis in Asia could have been much worse without the trading restrictions. Depending on the rate of decline and the time of day, circuit breakers will halt trading for half an hour to 2 hours so traders have time to assess the situation. Page 522. Michael Nagel and Exinwa and Alamy stock photo. Huge swings in the market cause a lot of pain among Wall Street workers and people in general. What have we learned from market bubbles like those in technology and real estate? In the late 1990s, the stock market reached unparalleled heights, only to collapse into a deep decline in 2000 through 2022. The bursting of the dot-com bubble was the primary reason. A bubble is caused when too many investors drive the price of something unrealistically high. In this case, dot-com stocks. The dot-com crash was unfortunately accompanied by disclosures of financial fraud at companies such as WorldCom, Enron, and Tyco. Investors trusted that the real estate value of these companies was fairly reflected in their financial statements. This trust was shattered when they found investment analysts often provided clients with widely optimistic evaluations and recommendations about companies they knew were not worth their current prices. After the financial downturn caused by the dot-com bubble, the stock market surged in the mid-2000s and set a new high. The market's growth was dramatic, especially in the real estate sector. From 2000 to 2006, prices of existing homes rose 50%. However, between 2006 and 2011, housing values fell $6.3 trillion. The real estate bubble was like the dot-com bubble before it. Investors believed that home prices would increase forever. Financial institutions reduced their lending requirements for buyers. Home builders overbuilt and buyers overspent, all sharing blame for the crisis. The government also contributed to the problem by requiring more mortgages be given to low and moderate income buyers, many with weak credit scores or no verification of income or assets. These subprime loans were pooled together and repackaged as mortgage-backed securities that were sold to investors. Discussed in Chapter 20, what followed were huge numbers of foreclosures, the failure of government-sponsored mortgage giants Fannie Mae and Freddie Mac, and more than 350 bank failures. The collapse of the real estate market cost the economy a combined loss of $8 trillion in housing and commercial property. Financial institutions like Lehman Brothers went out of business, and Wall Street icon Merrill Lynch was purchased by Bank of America. With financial markets in the worst condition since the Great Depression and the economy in a deep recession, the federal government took action. Congress passed a $700 billion financial package called the Troubled Asset Relief Program, TARP, that allowed the Treasury Department to purchase or insure troubled assets, to bolster banks and bail out the automotive industry, and insure American International Group, AIG. Unfortunately, in 2009, the economy recovered slowly and unemployment grew to double digits, causing Congress to pass on $800 billion in economic stimulus package, a blend of tax cuts and increased government spending that was intended to reduce unemployment and provide a significant boost to the crippled economy. In 2010, the government passed the Dodd-Frank Wall Street Reform and Consumer Protection Act that brought significant financial market regulation to the securities industry. Figure 19.8 highlights several regulations of Dodd-Frank designed to address some of the problems caused by the financial crisis. Page 523. Figure 19.8 cleaning up the street. Key Dodd-Frank provisions gave the government power to seize and shutter large financial institutions on the verge of collapse, put derivatives and complicated financial deals, including those that packaged subprime mortgages, under strict governmental oversight, required hedge funds to register with SEC and provide information about trades and portfolio holdings, created the Consumer Financial Protection Bureau to watch over the interests of American consumers by reviewing and enforcing federal financial laws. Since 2009, the economy recovered steadily and the stock market increased. Since 2009, the economy recovered steadily and the stock market experienced growth and again rallied to new highs. The Dow Jones Industrial Average closed at almost 30,000 for the first time in early 2020. The high close was short-lived, though, due to the outbreak of the COVID-19 global pandemic that shook the market. What should be obvious to you after reading the section above is the market undergoes frequent challenges and equally frequent periods of dramatic growth for investors. It's reasonable to assume that financial markets will likely experience additional changes in the future that will continue to heighten investor risk as well as heighten potential rewards. What's important to remember is to diversify your investments and be mindful of the risks of investing. Taking a long-term perspective is also a wise idea. There's no such thing as easy money or a sure thing. If you carefully research companies and industries, keep up with the news, and make use of investment resources, such as newspapers, magazines, newsletters, the internet, TV programs, and college classes, the payoff can be rewarding over time. Test prep. What does the Dow Jones Industrial Average measure? Why is it important? Why do the 30 companies comprising the Dow change periodically? Explain program trading and the problems it can create. Summary LO 19-1. Describe the roles of securities markets and of investment bankers. What opportunities do securities markets provide businesses and individual investors? By issuing securities, businesses are able to raise much needed funding to help finance their major expenses. Individual investors can share in the success and growth of emerging or established firms by investing in them. What role do investment bankers play in securities markets? Investment bankers are specialists who assist in the issue and sale of new securities. Page 524. LO 19-2. Identify the stock exchanges where securities are traded. What are stock exchanges? Stock exchanges are securities markets whose members are engaged in buying and selling securities such as stocks and bonds. What are the different exchanges? The NYSE is the oldest and largest floor exchange, but today does very little stock trading on its floor. The NASDAQ is a telecommunications network that links dealers across the nation so that they can buy and sell securities electronically rather than in person. It is the largest U.S. electronic stock trading market. What is the over-the-counter OTC market? The OTC market is a system for exchanging stocks not listed on the national exchanges. How are securities exchanges regulated? The Securities and Exchange Commission, SEC, regulates securities exchanges and requires companies that intend to sell bonds or stocks to provide a prospectus to potential investors. What is insider trading? Insider trading is the use of information or knowledge that individuals gain that allows them to benefit unfairly from fluctuations in security prices. LO 19-3. Compare the advantages and disadvantages of equity financing by issuing stock. And compare the advantages and disadvantages of equity financing by issuing stock and detail the differences between common and preferred stock. What are the advantages and disadvantages to a firm of selling stock? The advantages of selling stock include the following. 1. The stock price never has to be repaid to stockholders since they become owners in the company. 2. There is no legal obligation to pay stock dividends. And 3. The company incurs no debt, so it may appear financially stronger Disadvantages of selling stock include the following. 1. Stockholders become owners of the firm and can affect its management by voting for the board of directors. 2. It is more costly to pay dividends since they are paid in after-tax profits. And 3. Managers may be tempted to make stockholders happy in the short term rather than plan for long-term needs. What are the differences between common and preferred stock? Holders of common stock have voting rights in the company. In exchange for having no voting rights, preferred stockholders receive a fixed dividend that must be paid in full before common stockholders receive a dividend. Preferred stockholders are also paid back their investment before common stockholders if the company is forced out of business. LO 19-4. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds and identify the classes and features of bonds. What are the advantages and disadvantages of issuing bonds? The advantages of issuing bonds include the following. 1. Management retains control since bondholders cannot vote. 2. Interest paid on bonds is tax deductible. Bonds are only a temporary source of financing, and after are paid off, bonds are only a temporary source of financing, and after they are paid off, the debt is eliminated. 4. Bonds can be paid back early if they are callable. And 5. Sometimes bonds can be converted to common stock. The disadvantages of bonds include the following. 1. Because bonds are an increase in debt, they may adversely affect the market's perception of the company. 2. The firm must pay interest in its bonds. And 3. The firm must repay the bond's face value on the maturity date. What are the different types of bonds? Unsecured debenture bonds are not supported by collateral, whereas secured bonds are backed by tangible assets such as mortgages, buildings, and equipment. Page 525. LO 19-5. LO 19-5. Explain how to invest in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. How do investors normally make purchases in securities markets? Investors can purchase investments through market intermediaries called stockbrokers, who provide many different services. Online investing, however, has become extremely popular. What are the criteria for selecting investments? Investors should determine their overall financial objectives and evaluate investments according to 1. Risk, 2. Yield, 3. Duration, 4. Liquidity, and 5. Tax consequences. What is diversification? Diversification means buying several different types of investments. Government bonds, corporate bonds, preferred stock, common stock, global stock, with different degrees of risk. The purpose is to reduce the overall risk an investor would assume by investing in just one type of security. LO 19-6. Analyze the opportunities stocks offer as investments. What is a market order? A market order tells a broker to buy or sell a security immediately at the best price available. A limit order tells the broker to buy or sell if the stock reaches a specific price. What does it mean when a stock splits? When a stock splits, stockholders receive 2 or more shares of stock for each share they own. Each is worth half or less of the original share. So while the number of the shares increases, the total value of stockholders' holdings stay the same. Each is worth half or less of the original share. So while the numbers of the shares increases, the total value of stockholders' holdings stays the same. Stockholders hope the lower per share price that results may increase demand for the stock. What does buying on margin mean? An investor buying on margin borrows part The percentage allowed to be borrowed is set by the Federal Reserve of the cost of a stock from the broker to get shares of stock without immediately paying the full price. What type of information do stock quotations give you? Stock quotations provide the highest and lowest price in the last 52 weeks, the dividend yield, the price and earnings ratio, the total shares traded that day, and the closing price and net change in price from the previous day. LO 19-7. Analyze the opportunities bonds offer as investments. What is the difference between a bond selling at a discount and a bond selling at a premium? In the secondary market, a bond selling at a premium is priced above its face value. A bond selling at a discount sells below its face value. What is a junk bond? Junk bonds are high risk, rated BB or below. High interest debenture bonds that speculative. Junk bonds are high risk, rated BB or below. High interest debenture bonds that speculative investors often find attractive. LO 19-8. Explain the investment opportunities in mutual funds and exchange-traded funds ETFs. How can mutual funds help individuals diversify their investments? A mutual fund is an organization that buys stocks and bonds and then sells shares in those securities to the public, enabling individuals to invest in many more companies than they could otherwise afford. Index funds have become particularly popular among investors. What are ETFs? Like mutual funds, ETFs are collections of stocks that are traded on securities exchanges. They are traded more like individual stocks. Page 562. LO 19-9. Describe how indicators like the Dow Jones Industrial Average affect the market. What is the Dow Jones Industrial Average? The Dow Jones Industrial Average is the average price of 30 specific stocks that analysts use to track the direction up or down of the stock market. Key terms: bond, buying stock on margin; capital gains, common stock, debenture bonds, diversification, dividends; Dow Jones Industrial Average, the Dow; exchange traded funds, ETFs; initial public offering, IPO; institutional investors; interest, investment bankers; junk bonds; maturity date; mutual fund, NASDAQ; over-the-counter OTC market; preferred stock, program trading; prospectus, Securities and Exchange Commission, SEC; sinking fund, stockbroker, stock certificate; stock exchange, stocks, stock splits. Critical thinking. 1. Imagine you inherited $50,000 and you want to invest it to meet two financial goals: A, to save for your wedding, which you plan to have in 2 years, and B, to save for your retirement several decades from now. How would you invest the money? Explain your answer. 2. If you are considering investing in the bond market, how could information provided by Standard & Poor's, Moody's Investor Service, and Fitch Ratings help you? 3. Why do companies like callable bonds? Why are investors generally not very fond of them? 4. What is the major advantage of a convertible bond? 5. If you were thinking about investing in the securities market, would you prefer individual stocks, mutual funds, or ETFs? Explain your choice by comparing the advantages and disadvantages of each. Putting principles to work. Purpose: to experience using online tools to gather stock information. Exercise: long gone are the days of paying a stockbroker to research stock information for you. Now you can readily find all the information you need online yourself. Go to Yahoo Finance at finance.yahoo.com and click Screeners at the top of the screen, then click Equity Screener. Create a screener that filters for large cap health care stocks in the United States. Page 527. 1. Choose 3 stocks and learn more about them by clicking on their ticker symbols. What is the dividend rate yield of each? 2. Find what financial analysts recommend for each of these stocks by clicking the Analysis tab. Do analysts recommend buying, holding, or selling each of your picks? 3. If you bought 100 shares of each of these stocks 5 years ago, how much would you have invested? How much would those stock holdings be worth today if you didn't reinvest dividends? Hint, click on historical data, then time period, then 5Y. Select monthly frequency. Base your calculations on the first and last days. Closing prices. 4. What if someone gifted you $1,000 in Apple stock the day you were born? Use the calculator at finmasters.com and Stock Calculator to find out how much the stock would be worth today. Developing career skills. Key. Team analytic communication technology. 1. Go to the websites of Charles Schwab, schwab.com, Trade, etrade.com, and Interactive Brokers, interactivebrokers.com. Investigate each of these brokerage companies to compare their fees and what they offer in terms of research and advice. Which firm seems most appropriate to your investment objectives? Be prepared to defend your choice to the class. 2. Visit MSN Money or Yahoo. Finance and select 6 stocks for your portfolio, 3 from the NYSE and 3 from the NASDAQ. Track these stocks daily for 3 weeks using the graphs provided on the websites to see how market trends and information affected your stock's performance. Report your observations. 3. U.S. government bonds compete with corporations for investors' dollars. Check out the different types of bonds the federal government offers and list the types of U.S. government bonds compete with corporations for investors' dollars. Check out the different types of bonds the federal government offers and list the types most appealing to you. Hint, see treasurydirect.gov. Be sure to check out tips and be able to explain how they work. 4. See whether anyone in class is interested in forming an investment group. If so, each member should choose 1 stock and 1 mutual fund or ETF. Record each student's selections and the corresponding prices. In 3 weeks, measure the percentage of change in the investments and discuss the results. 5. Go to the website of Charles Schwab, schwab.com, Trade, etrade.com, or Interactive Brokers, interactivebrokers.com, and find 2 IPOs offered in the past year or 2. Track the performance of each from its introduction to its present market price. Report your observations and conclusions about the stocks. Career exploration. If you are interested in pursuing a career in the securities industry, here are a few opportunities to consider. Make sure to find out about the tasks performed, skills needed, pay, and opportunity outlook in these fields in the Occupational Outlook Handbook, OOH, at bls.gov. Personal Financial Advisor provides advice on investments, mortgages, insurances, college savings plans, estate planning, taxes, and retirement to help individuals manage their finances. Investment Banker connects businesses that need money to finance their operations with investors who are interested in providing that funding. Assists with company mergers and acquisitions. Stockbroker sells securities and commodities directly to individual clients. Advises clients on appropriate investments based on their needs and financial understanding. Financial Analyst provides guidance to businesses and individuals making investment decisions, assesses the performance of stocks, bonds, and other types of investments. Page 528, video case, McGraw-Hill Connect. Investment advice from the motley fool. Have you ever thought about being rich? One piece of advice: don't depend on winning the lottery to earn your fortune. One path to accumulating wealth is through investing, and the best time to start is now. Many great fortunes have been built over time. The more you understand about investing and investment options and strategies, the greater your chance of success. This is where The Motley Fool can help you in your investing career. The Motley Fool is a publisher of financial advice that can help you understand securities markets. Before starting investing, it's important to know the difference between primary and secondary markets. The primary market is where companies sell new securities for the first time, called an initial public offering, IPO. Companies that are selling stock are offering investors part of the company itself. By buying shares of stock, you become an owner in the company. After the securities are sold for the first time, they become part of the secondary market. This is where investors can buy and sell securities between each other. Companies receive no more from the trades. Companies receive no money from the trades. In the secondary market, it's important to know the differences between stocks, bonds, and mutual funds as possible investments. Stocks represent ownership in a company. Bonds signify an investor in lending money to a company that will be repaid at a future date, with interest paid the investor until the repayment date. Bonds signify an investor is lending money to a company that will be repaid at a future date, with interest paid the investor until the repayment date. With interest paid the investor until the repayment date. Put simply, bonds are debt. Mutual funds are baskets of stocks or bonds that investors can purchase that helps spread your investment risk over multiple stocks or bonds of different companies. Mutual funds reduce your risk of heavy losses if you invest in just one company. For example, once you fully understand the differences between the potential investment choices, you are ready to start your path to financial success. Mutual funds reduce your risk of heavy losses if you invest in just one company. For example, once you fully understand the differences between the potential investment choices, you are ready to start your path to financial success. In the past, it was often complicated and expensive to start investing in the stock market. It was necessary to pay a financial professional, stockbroker, to purchase shares on your behalf. Also, there could be requirements on the number of shares you could purchase. Today, things are much easier to start investing in the market. All you have to do is open a brokerage account at a bank or brokerage firm such as Charles Schwab, and off you go. The fees charged for trades you make are zero, as opposed to what used to be sometimes hundreds of dollars to make trades. You can even buy fractions of a share of stock in high-priced companies. If you are still a little shaky about making the move into investing, you can seek the assistance of a broker or financial advisor. A broker is an intermediary that makes trades for you. A financial advisor is professionally bound to put your best investing interests first. Often, a financial advisor can provide broker services and make trades for you. It's important that you make sure your financial advisor always has your best interest in mind and knows exactly what your investment objectives involve, i.e., retirement, kids to college, etc. That's why continuing to learn about markets and investing is important for your future financial success. The Motley Fool is a strong believer in thinking about the long term and being patient in managing your investments. It recommends holding stocks for at least 5 years and diversifying your investment portfolio with multiple investments. It also recommends only investing money that you will not need for at least 3 years due to the ups and downs the market undergoes. The market will always have risks, but putting your money under a mattress or buying it in the backyard will gain you nothing. If you are patient and continue to study about investing, the compounding power of the market can make life easier and more profitable. Thinking it over. 1. Why do companies receive no financial gains from trades in the secondary market? 2. What's the major advantage to new investors to invest in a mutual fund as opposed to individual stocks? 3. How is a financial advisor different from a broker? Page 529, page 530. Notes. Chapter 20, Money, Financial Institutions, and the Federal Reserve, page 531.